So let's continue talking about capital structure. And now let's move to think more about agency costs. If you remember what agency costs are, these are costs that come from conflicts of interest between shareholders or stakeholders, So management generally is going to make decisions that increase the value of equity. However, sometimes when they have leverage, they might make decisions that benefit shareholders, but ultimately may harm the firm's creditors. And in the end, since the value of the firm is the same, regardless of whether we have debt or equity, then in the end, we're going to ultimately reduce the total value of the company because of these agency costs. So here's a company. Let's say they have a loan of $1 million at the end, due at the end of the year, and without a change in strategy, the value of its assets only going to be $900,000. So they're going to default on this debt. So they're considering a new strategy. This strategy doesn't require any investment up front, but it only has a 50% chance of success. If it succeeds, the value of the company goes to $1.3 million. If the strategy fails, the value of the asset falls to $300,000. So what is the value of the company under this new strategy? Right? So 50% of the 1.3 plus 50% of the 300, we now have the value of this company is estimated to be in $800,000. So despite this negative expected payoff, some within the company suggest, we should go ahead with this strategy. So the question we have is, even though we estimate the value of the company goes from $1 million to $800,000, should we do this project? It's negative. If they do nothing, it's ultimately going to default, and the shareholders get nothing, right? So at least if they try this, there's a possibility of some benefit, if you will. So if the strategy succeeds, the equity holders are going to get $300,000 after paying off this debt. And of course, there's a 50% chance of that happening. So the equity holders' expected payoff is $150,000. So even though there's a negative expected payoff, the equity holders gain, but the debt holders lose, right? So if the project succeeds, the debt holders are fully repaid. But if it fails, they only get $300,000. So the expected payoff, again, is $650,000. They either get $1 million or the $300,000. That's this $650,000 value. And the debt holders' loss then are going to lose $250,000. That comes from the $100,000 decline in firm value because of the strategy, but also the equity holders are going to gain $150,000 in value. So what happens is the equity holders are essentially gambling with the debt holders' money, right? The debt holders are going to lose in general, right? But the equity holders ultimately gain, and the debt holders pay for this. So this asset substitution problem, right, it says when a company faces financial distress, shareholders can gain at the expense of debt holders by taking negative net present value projects if it's sufficiently risky. So they have an incentive to invest in negative projects that are risky. Again, in the end, the idea is if they come true, there's a big benefit. But if they lose, in the end, we were going to lose anyhow. The company was going to maybe go into bankruptcy, and we were going to liquidate. So we might as well take this chance, if you will. Now, there's another type of thought that could be prevalent under this agency cost idea. And this is what's referred to as debt overhang or underinvestment. So now let's assume we're not going to do this risky strategy. We're considering an investment opportunity. It's going to cost us $100,000. It's going to generate a risk-free return of 50%. So it's obviously a positive net present value project. So what if I don't have the cash on hand to make this investment? Can I raise $100,000 in new equity in order to make the investment? Does that make sense for us to do? So let's think about this. If the equity holders contribute the $100,000, they get back only $50,000, right? The other $100,000 from the project goes to the debt holders, whose original payoff was only $900,000 if they were to go bankrupt. So they are going to ultimately bring the debt holders up to the value of the debt. So the debt holders receive most of this benefit. So this project is a negative net present value opportunity to equity holders, even though it's a positive net present value for the firm. And again, in the end, what we're looking at is who gets the cash, who gets the value from these projects. In the end, the value really doesn't change dramatically. It's whether it's all equity or the ending value of the company under a strategy doesn't change, whether it's all equity or whether it's levered. What happens is, how is the money exchanged? What is the ratio, if you will, of how things get distributed? So this debt overhang is a situation where equity holders choose not to invest in good projects because the company's in financial distress. And if they're good projects, we're not going to receive all the benefit. Some of that benefit is actually going to go to the bondholders. And in the end, obviously, we're just going to pass on these new positive net present value projects. This is what they refer to as the debt overhang problem. When companies face financial distress, shareholders also have an incentive to withdraw some money from the company. This is what's referred to as cashing out, right? If the company is likely to default, the company might sell off assets. It could do that below market value, and then it could pay an immediate cash dividend to the shareholders. So again, this is kind of underinvestment because we're selling off plant and equipment at below their market value. Again, we would only do this if we were facing financial distress. So, leverage can encourage managers and shareholders to act in ways that reduce firm value. Okay? It appears that equity holders benefit at the expense of debt holders. However, as we've shown in several different kinds of examples, in the end, it's the shareholders who bear the agency costs from these types of strategies. So the debt holders may pay the bill, they may pay the cash, but in the end, the value is impacted in the value of the equity of the company. So when a company adds leverage to its capital structure, there are actually two things that happen to price. The share price benefits from the equity holders' ability to exploit the debt holders in bad times. The debt holders, however, recognize this possibility. They see that as increased risk, so now they are going to pay less for the debt when they're issued so they can get a higher rate of return, again, because of the risk. Now, what this does is ultimately reduces the amount the company can give to shareholders. In general, though, what we find, though, is the debt holders lose more than shareholders gain from these activities, right? So there is a net loss regardless of what happens. And this will actually impact the share price of the company before we propose any of these kinds of strategies. So there's something referred to as the leverage ratchet effect. And this talks about once existing debt's already there, right? Shareholders have an incentive to increase leverage, even if it decreases the value of the firm. And they're not going to have an incentive to decrease leverage by buying it back, even if it increases the value of the firm, right? So, I think it kind of boils down to something a little bit more fundamental and simpler, right? Shareholders want all the benefits. Creditors, they're willing to utilize the assets of somebody else for their benefit. And if losses are possible, they are willing to share those losses with with somebody else. In this case, they want to share those losses with creditors. So we're going to move on and talk about more agency issues, more thoughts that go through the minds of managers and debt holders as we think about leverage in the company.